Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi Singh. Welcome to our weekly podcast. Global equities remain volatile over the past week amid mixed economic data and concerns with the US regional banking sector. However, sentiments improved later in the week after strong earnings reporting by major US corporations and jobs data which showed the US economy added more new jobs in April than market expectations, while unemployment rate fell further to 3.4%. During the week, two major central banks continued to raise policy rates. The US Fed raised policy rates by 25 basis points and signaled a likely pause as its post-meeting statement omitted the phrase, "The committee anticipates that some additional policy firming may be appropriate for the Fed to achieve its inflation goal." The European Central Bank also raised its policy rates by 25 basis points, a departure from its 50 basis points hikes earlier. However, the ECB president made it clear that the ECB is not pausing yet and that there is more ground to cover in its fight against inflation. Major emerging market equity indices managed to post gains over the week, with the MSCI Asia ex-Japan and MSCI Emerging Market Indices rising 0.5% each, while MSCI China Index declined 0.2% for the week. In the US, the S&P 500 and Dow Jones Industrial Average fell 0.8% and 1.2% respectively, while the Nasdaq Composite Index rose 0.1% for the week. Back home, Indian equities remained resilient over the past week, supported by positive corporate earnings and improving foreign investor inflows. The Nifty index closed flat over the truncated week, while broader markets continued to shine, with the mid-cap index up 1.1% and small-cap index up 0.6% for the week. Among sectors, autos and capital goods were the best-performing sectors, with gains of over 1.2% for the week, while banks was the worst-performing sector with cuts of around 1.3% over the week. The Indian fixed income market had another decent week, with bond yields falling across the curve, tracking a sharp fall in US bond yields as traders anticipated a likely policy pivot after a final rate hike in May. The RBI drained INR 85 billion from the system via 14-day reverse repo auction. For the week, the 10-year Indian government bond yield fell 11 basis points to close at 7.01%, which was a 13-month low, while the 3-year and 5-year Indian government bond yields fell 4 basis points and 5 basis points respectively for the week. The INR remained flat against the USD as strong dollar buying by domestic banks negated the positive impact of lower crude oil prices, weaker USD, and improving foreign investor inflows. For the week, the INR closed at USD 81.8 per dollar. Among other key updates during the week was on India's PMI. India's manufacturing PMI rose to a 4-month high of 57.2 in April 2023 from 56.4 in the previous month, as both output and new orders grew the most in 4 months amid sustained expansion in sales. On the pricing front, input cost inflation accelerated due to faster sales in the prices of transportation and raw materials, while output cost inflation rose to a 3-month high. India's services PMI rose to a 13-year high of 62 in April 2023 from 57.8 recorded in the previous month. Both output and new orders rose at the fastest pace since June 2010, with export business gaining for the third month and advancing the most sequentially. On the pricing front, input cost inflation accelerated to a 3-month high due to higher costs of food, fuel, medicine, and transportation. Overall, composite PMI rose to 62 from 57.8 last month. At this point, I'll take a pause and thank you as always for listening. If you enjoyed this podcast, please like and subscribe. Have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.